silver took that out in a big move. Now it's kind of pulling back to that breakout point where what used to be overhead resistance now looks like support. And so to me, when I look at that chart, I just see a bullish breakout. I'm not worried about the move from 120 down to the 50s. I'm putting that in context. And again, if you zoom out and you look at that longer term chart, look at where silver started. That is a beautiful bullish chart in the 60s and 70s that led to 1980. I mean, that was a big move. Silver basically went from $1 an ounce to $50 an ounce. So that was a 50x move. We're nowhere near a 50x move on this leg.
The current technical setup of the silver market points to a highly constructive long-term breakout pattern. After clearing key multi-decade overhead resistance zones, the asset is undergoing a healthy retest of its former breakout bounds to establish firm foundational support. Peter Schiff, a renowned economist and global financial strategist, notes that this price correction remains thoroughly constructive within a broader cyclical macro bull run. The monetary landscape indicates that structural government debt traps will prevent sustained asset class deflation, forcing global central banks to continually expand their balance sheets. Consequently, traditional consumer purchasing power will face ongoing debasement as core dollar-denominated prices for consumer goods push structurally higher over the multi-year horizon. While paper markets continue to focus on volatile macroeconomic prints, the underlying trend points toward a sustained upward re-rating for commodity blocks. Now, we present the clips from Peter Schiff's interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
The only deflationary force would be in asset prices. So when people are talking about deflation, they're not talking about grocery prices coming down. That ain't going to happen, right? The prices that they're talking about would be stocks, real estate, and that's what scares everybody because there's a lot of wealth there on paper and there's a lot of leverage there. There's a lot of debt that would be in default if the assets collateralizing the debt, were to lose value. So that would happen. But in order to prevent that from happening, the government has to create inflation. They have to print more money. They have to keep interest rates artificially low. So you're not going to see the big decline in asset prices. You may see a decline, but I think the government will truncate it with inflation. But what the consumer is going to experience is ever increasing goods prices. And of course, the way you will see deflation is the same way we've been seeing it. You got to price assets in gold. You put up that chart of the stock market, put it up priced in gold. It looks very different. The market is lower than it was 20 years ago, priced in gold. So you could say we've been deflating for 20 years as long as you measure it with gold. If gold is your monetary measurement, then we've had deflation for over 20 years. But consumer prices, even then, even if you measure the CPI in terms of gold, everything is cheaper. Right? Food is cheaper today than it was if you got gold. So we're experiencing deflation. It's just that very few people realize it because they don't have gold. They have dollars. And if you have dollars, you got inflation. So gold is unique in that respect. Even if you're not using it, you can still hold on to it so somebody else could use it. And the thing is, even if you do use gold, like I'm using gold in this jewelry, somebody could melt it down, take the gold out and get it back. Now, the watch will probably always be more valuable as a watch than if you break it apart. But that's not the case for all jewelry. There are a lot of jewelry that, that doesn't have the value of like a Rolex, right? And in that case, you can just melt it down and get the gold and start all over again. And it's exactly the same. Copper didn't have the crazy explosive move that silver had. It's been a steady climb for copper to new highs. Silver kind of went from $30 to $120 in really a matter of months. And so that was like a crazy move that has been, reversed. And so now silver is trading in the mid to upper 50s. But that still would have been record territory, a few months ago. And silver, if you pull up, you're looking at charts. If you pull up a silver chart and look at that breakout, you can look at the overhead resistance that went back to 1980, and then came up again in 2011. Silver took that out in a big move, and now it's kind of pulling back to that breakout point where what used to be overhead resistance now looks like support. And so to me, when I look at that chart, I just see a bullish breakout. I'm not worried about the move from 120 down to the 50s. I'm putting that in context. And again, if you zoom out and you look at that longer term chart, look at where silver started. I mean, that is a beautiful bullish chart. And it looks like there's no overhead resistance. I don't think the 120 peak is going to be any kind of substantial resistance, nor do I think, a lot of people are trying to compare it to the peak that we had in 1980. And they're saying, oh, this is going to be a generational high in silver. This doesn't look anything like that. Because look at how much time we went sideways between 1980 and now in the 60s and 70s that led to 1980. I mean, that was a big move. Silver basically went from $1 an ounce to $50 an ounce. So that was a 50x move. We're nowhere near a 50x move on this leg. So either copper is going to come down or silver is going to go up, right? So,
right.
And I think that copper is going to keep going up. So I think silver is going to go up. I think that this is a pullback, which, as far as I'm concerned, I think it's very healthy. And there's still a lot of people that I would like to buy some silver, and I'd rather them pay, $55, $60 an ounce than $120 an ounce.
The technical data shows a dramatic historical discrepancy when evaluating traditional equity indexes against hard asset benchmarks. While major equity metrics appear to be achieving nominal highs in paper currencies, the entire stock market is trading substantially lower than its valuation mark from 2 decades ago when accurately priced in physical gold. This clear structural divergence indicates that true capital preservation is only being achieved through tangible monetary assets rather than leveraged corporate paper. At the same time, individual tech equities and alternative digital assets are showing major fragmentation beneath the surface, with many components experiencing massive individual corrections, even as major indexes are temporarily sustained by a narrowing handful of mega-cap names. With core sovereign bond yields pushing toward multi-year heights, the massive accumulation of public and private debt instruments faces an unprecedented refinancing squeeze. The broader economic system is steering directly into a major credit crisis that will drastically surpass the structural damage observed during the 2008 financial collapse. Now, let's get back to the interview.
I mean, consumers always adjust their behavior to prices. That doesn't stop the inflation. So the fact that consumers are responding to higher food prices by altering the composition of what they purchase. They purchase less steak and more hamburger. Or maybe if they've already switched from steak to hamburger, they have to go from hamburger to tofu or something, or eventually they're stuck with dog food. But that doesn't stop the inflation. To look at the numbers that we got in June and to get excited about it, oil was down 30% in June. And that was a big factor. And that was because of the peace deal. Well, the peace deal is off. The war is back on. Oil prices are already up 20% in July. And we still got the second half of the month. So it's very possible that all of the decline that we saw in oil in June is reversed in July. So why get excited about it? Meanwhile, the numbers are still way above the Fed's 2% target. We're not even close to that. I mean, yes, there's a 2 to the left of the decimal point. So it's less than 3. but it's still closer to 3 than 2. And again, this is how the government officially reports price increases. It's not the actual price increases that the consumers are paying. You got to double that to get closer to reality, because the government numbers are just a fantasy, but they're created in order to provide the government with cover. It's like, if we let our kids grade their own report cards, we wouldn't, expect them to come home with straight D's and F's, right? They're going to give themselves A's or A's and B's, and that's what the government does with the CPI. The government is grading itself, and so it's giving itself an inflated grade. I mean, gold is just below 4,000. It's not way below. 39.90-ish.
Right.
But bond yields continue to rise. The yield on the 30-year bond is now 5.12. This is the highest it's been in this move. The 10-year is just off its highs, just below 4.6. But that's also pressuring gold and silver. But a lot of it is coming from Kevin Warsh and the belief that there's some kind of regime change at the Fed. And even he's calling it regime change. And in my mind, it's just as legitimate as the regime change in Iran, which is no regime change. He's acting like he's going to, get tough on inflation, and he's going to succeed where his predecessor, Powell, failed. And he's actually going to bring inflation down to 2%. And he's going to do, whatever it takes to achieve that. And so the markets are, for some reason, at least the precious metals market, believe him. But I don't believe him for a second. I don't think there's any chance that he's going to do that. I don't think he has the ability or the guts to do it. In fact, at the Senate yesterday, one of the senators asked him specifically, what are you going to do to bring inflation down? And he said, well, I got 3 things that I'm going to do. And all 3 things amounted to talking about what he's going to do. So it's all talk. And if you look behind the talk, what is the Fed doing? They're still printing money. The balance sheet is growing. Money supply is growing, and they haven't hiked rates. So to me, it's the same old, same old. They're just putting it in a different wrapper, and they're hoping to buy, some cheap credibility by talking. But ultimately, there's not going to be any actions to back up their words. And Kevin Warsh even admitted that quantitative easing often shows up in asset prices before consumer prices. And he admitted that inflation was the result of monetary policy. But now he's pursuing the same monetary policy that created it. So what's the difference? Yes, you could be truthful and say, yes, inflation is a choice and it's the result of the Fed's monetary policy, but he's making the same choice and he's conducting the same policy. Both the NASDAQ and the Bitcoin were in a bubble. The main difference is that Bitcoin was pure bubble. It was all hype. There was no substance behind it. Whereas in the NASDAQ, you have legitimate companies that are earning money. It's just that the market was assigning an excessive valuation to these companies. The prices were much higher than what the companies were actually worth. Now with Bitcoin, the entire price was above what Bitcoin was worth, which is 0. So the Bitcoin bubble just popped before the overall NASDAQ bubble. But I would say that even within the NASDAQ, many of the stocks are no longer going up, just like Bitcoin. Mm-hmm. It's just that the index itself is dominated by a handful of names that are still going up. But beneath the surface, many individual stocks, just like Bitcoin, have cracked, and they're not participating. So the rally is getting more and more narrow as we go higher. And you're starting to see the companies that are left behind and the tokens, and I think because Bitcoin was kind of the weakest link in the chain and all of crypto, not just Bitcoin, that's the link that kind of broke first. And so Bitcoin started to go down before a lot of the other NASDAQ stocks started to go down, but they are going down. In fact, interestingly enough, SpaceX yesterday, and again this morning briefly, traded below the IPO price. A 40% decline from the post-IPO high. So the bloom came off that rose pretty quickly. And we're starting to see, other moves down in tech. Look, IBM was down like 25% the other day.
Yeah, I saw that. 24%, 25%.
Yeah, it's huge. So I think that the market is setting up for a bigger decline. And if yields keep backing up, which it looks like they will, if we start to see the 10-year Treasury, not only move above 4.6%, but 4.7%, and then start heading up to 5%, the 30-year is already at 5%. It's above 5%. And when the 10-year gets above 5%, we got a big problem because, the last time the 10-year was above 5% was 2007. And obviously that was kind of before the financial crisis hit.
Mm-hmm.
But if a 5% 10-year helped produce the financial crisis back then, the national debt had barely hit 9 trillion back then. It's now 40 trillion. So imagine the crisis that's coming now, because we have a lot more debt. Even mortgage debt. Mortgage debt is significantly higher today than it was in 2007. And that was the housing bubble. Now, the mortgage debt is not percentage-wise. The increase is not nearly as much as the government debt, right? But taken in totality, there's just a lot more debt now in the public and the private sector. And so interest rates moving up are going to be a bigger problem than they were then. And back then, they were big enough to create the financial crisis.
The underlying commodities complex reveals a massive pricing mismatch between primary industrial metals and core precious monetary metals. While industrial copper has maintained a steady, incremental advance to establish completely new cyclical highs, silver prices experienced an incredibly rapid surge up to the $120 mark before undergoing its current sharp consolidation back into the mid to upper $50 range. This massive correction provides an exceptionally attractive accumulation window for long-term investors to secure physical positions at a deep discount before the next major macro leg begins. As structural interest rate pressures continue to strain the broader public banking architectures, physical precious metals will inevitably re-accelerate to completely bypass former peak valuation resistance points. The macro evidence indicates that silver will climb significantly higher to catch up with the broader copper advance as fiat structures weaken. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.